Hello again. Let's get right to it. Today we will talk about a stock because the really great thing about the KISS strategy is that it literally works on any asset. Any asset class, any market, really doesn't matter. You have to adapt, obviously, to the volatility of the asset. You need to define the important zones. You just do the work that I lay out in these videos again and again and again, right? You look for the important zones, you look for the dynamic support resistances, for the structures, and you just combine these things, and these things bring then the probabilities on your side. They are based on a statistical edge. They are based on the 7 building blocks that I teach. And this is literally how you can trade any market because this is a method. You're not hoping, you're not gambling, but you're actually applying a mathematically sound method that you can follow that allows you to be cool with your emotions, to take risk when it's actually worth to take it, and also to cut your risk when it's worth not taking it. And I think this is a good example here to show you how actually here I decided to not take more risk, where others may have decided to actually take more risk. This trade hit the stop loss. So it's again a negative example, but I think you learn more from negative examples than from positive ones. Let me get right to it here. So first of all, let me see. Again, let me remove my cute face over here. So we're looking at CleanSpot. CleanSpot obviously also has a bit of fundamental things going on with the whole situation being like, more or less a beta to Bitcoin and like extremely volatile and the whole, MicroStrategy, Trump election, strategic reserve. So there's a lot of stuff happening in the background as well. But nonetheless, this strategy is technicals only. So whatever happens on the fundamental side will still reflect in the prices and the technicals. So don't stress yourself. You could just consider or decide to stay out of an asset class when there's a lot of fundamental influences going on there, right? And this, again, other than a currency trade, this is a clean asset, right? So it's not two economies push and pulling, but this is actually just the price of one asset, okay, versus the US dollar in this case. So here you see we tried to buy this after there was actually a nice move to the upside, but we hit the stop loss. And so what happened here exactly? First of all, we did our regular analysis. We don't add the weekly structure. You could see there was a healthy trend going up, right? Like it broke up, created this higher low, then it ranged up here, it broke back down, but when it broke down, it didn't break this structure, and then it went back up actually. It didn't break the structure. This is why we were looking at this structure as our target, right? Because when it came, when it went back up here, and then it had like some sort of a correction, that was our entry, like when in this zone, in this range zone, that we could actually then take a trend continuation. That's the basis of the trading strategy, right? Didn't work out. As you can see, we hit the stop loss. Let's go a little bit further here. The daily structure was also relatively fine. We had like this consolidation, right? Like this is this part on the weekly. And the market broke. It tried to get back into that range. It failed first, but it came down. But after the failure, it did not break this structure, which is mildly bullish rather, right? And then it went back up and then it failed to reach this high, so it made a correction here. That correction was on this support level, right? You see the blue lines? Those are our important price zones that we define. And this is where we actually put our entry because we were looking to take this correction back up here, right? So whatever the daily structure, you can see that it looked like it would be able to break out, but it didn't necessarily happen here in this case. No big deal. I mean, again, these things happen. And this is actually one of the learnings of these trades here as well, is that even the best setups can fail. And that's absolutely no big deal. If, again, in the bigger number of your trades, you actually win more than you lose, you manage your risk properly, you don't overtrade, you plan your trades, you trade your plan, you follow your statistical edge method, and then everything's gonna be fine. You don't rush into things, you're not impatient, you're not insecure. None of these things are actually part of your reality. Totally cool. So the 4-hour structure, what do we see here? We see also that when the price came down, it made this range here, it broke up the range, right? It failed to break back into this upper one, came back down, but this is what we showed earlier on this chart here, but it didn't break back lower down here. So that's actually good because then it had a big move up. You can see the volatility of this asset is quite I mean, a lot, like we go from 976 to $17. This is quite a move. And then it came back down and it held here at that support level, which we defined here again. This is our point of interest. And we wanted to enter here. So the 4-hour structure also bullish. Everything's fine. That's why it's a 10 out of 10 setup. So now we look at the support and resistance zones on the weekly. You can see that. Well, how do we define those? I explained it multiple times. Where did the price react multiple times more, let's just say heavily, and in the same type of price range? And you could see like this area, this area, this area, and also as it came back down and came back up, it came back to this area. So the let's just say the $13 area here was very much why we chose it as an entry, because it has proven to be an area or a price zone that was revisited multiple times as resistance, as support. So this is why we were looking at this level on the weekly. Now, if we look at it on the daily, we can see the same thing, really, right? Like as the price went back down and it ranged here, it broke through that range, it came back down, but it held that range. Nonetheless, there is now also here around an $11, another important price level that we saw the price actually here reacted once, and also we were hovering here around before it went back down. So this level is actually an interesting level, which I will explain in a moment, because that will have to do with our trade management decisions. One of the 7 building blocks is trade management, because how we manage the trade when we're in the trade after we've opened the trade is also a big decisive factor of winning or losing a trade, right? Or winning or losing more, actually. So here we have also the support and resistance zones on the 4-hour. Again, you could see that these levels here, and as we've defined them, they continue to show significance, very simply stated. And the target was the upper end of that range here. So we're really also trading a familiar price level and not trying to extrapolate some crazy Fibonacci into the universe, but actually, trading a real chart in front of us. So what happened here? The price actually, when we look at the dynamic support is another thing that we always look at, which is moving averages. We also look at it on different time frames to see, is the price holding above it? Is the price trading below it? Is the price being supported by it? And this is what we're seeing here. So we see that on the weekly, that in fact this area here where our support level is has been like a support area for, like, the price was trading okay-ish, trading at on the moment we entered the trade, which is here. It's a little bit confusing because you see the rest of the trade as well. It was trading above it, right? So it came back under the support, it broke back up on the support, and when it corrected back and we wanted to take the continuation back on, we were trading above the weekly dynamic support, which is supporting our thesis of a bullish structure. The same now also on the 4-hour. You can see here is blue line. So the price was trading, first was below it, right? Then ranging around it, failed, broke it, came back down, held above it. And this is where we wanted to enter our trade. So our dynamic support was confluencing actually with our here point of interest price zone. So we had a combination, like we had the dynamic support and, in fact, the market structure, both aligning well around the $13, which supported our trade idea even more. And this is why it was a 10 out of 10 trading setup from the looks of it. So we entered the trade here around $13, a buy entry. You could do it with a limit, you could do it with a market, doesn't really matter too much. And what happened then, though, is, we needed to define also the price range. That's very important, because if you don't know what you're going to do, then you will be blindsided by the market. You will make decisions that are emotionally charged, that are not pre-planned, that are not sound. They are stupid, basically. So clearly, why is it important that I define my trading range and the invalidation? Because when the trade is not really going to happen anymore, I should exit the trade and I should not look back. And that would be down here. So the idea was, if the price comes back down, we will look at this area, the $11, because it was a support before. But if we go back here below the $10, then in fact, we will just have a stop loss and exit the trade. Done with it. And in fact, this is what the price did. First, we entered, and then it ranged, and then it broke over down to that $11. And now that $11 is actually a very important thing, because down here, a lot of people would consider to add to this trade now. A lot of people would say, like, okay, we're going to add and then take it back up. And in general, if you had split your risk, if you had not entered with your full risk here, this could have been an idea. But nonetheless, this is a weak structure. This is not a structure where you want to look adding aggressively. Why? Because this, for example, would be or would have been a better structure. If the price had range, remained basically in the range, broke up to retesting that range, came back down to this important area, this is where I would have added to the trade. So I would not have, that structure would have been a lot more healthy. That would, give me a higher probability of going upwards from there. So instead of, doing adding here, I would have done that. But, the universe or fate didn't play along, and the price hit the stop loss. It ranged, went to this $11 and then actually went back down. And I got out of the trade. I didn't burn my account. I had one loss, which is totally fine. Controlled risk. You don't bet the farm on any single trade. You win over numbers. It's a numbers game. Don't stress about it. Follow your method. Plan your trade your plan. All cool. Statistical edge. 7 building blocks. Be happy. Make money. Very good, So what's the learning here? The learning is even 10 out of 10 setups fail. It's just what it is. And also, actually, it's more a reminder than a learning, but don't add risk without a proper structure. So, and I thought that was, when I was journaling this trade, it was something that really stood out in my notes, is that I was happy that I was not, because with all this crypto hype and MicroStrategy and the Donald Trump and strategic reserve, you just want to buy dips in whatever is crypto, right? But no, you don't. You always follow your method, and this is how you win long term. So this is another example of a trade. I'll do some more. If you'd like me to do, anything specific, leave a comment. If you like this video, please be so kind. Leave a like, share it with your friends. I'd be thrilled to have more people see what we're doing here and hopefully take also value out of it. Thank you very much for watching, and I'll see you in the next video.